This is Nightly Business Report with Tyler Matheson and Sue Herrera.
And Oracle's optimism. The world's most influential investor, Warren Buffett, says, don't bet against America. And he shares his outlook for stocks, the economy, and one of his biggest holdings.
Blunt message. General Electric CEO didn't mince words, writing a no-holds-barred letter to shareholders.
Leaping forward, why Leap Day is a great time to get a jump on your financial goals. All that and more on Nightly Business Report for Leap Day, February 29th.
Good evening, everyone. Glad you could be with us. A legal ruling in favor of Apple in one of its many cases against the government. We'll have more on that in just a minute. But we begin tonight with Warren Buffett's letter to shareholders. One of the world's most admired and, of course, successful investors remains optimistic over America's future, saying this country's productivity and what he calls economic magic remains alive and well. In his much-anticipated annual letter, Mr. Buffett talked about business at Berkshire, his investments in IBM and American Express, both of which have seen their shares stumble, and defended his relationship with private equity firm 3G. And this morning, in a wide-ranging interview with CNBC, Buffett made his optimism on the stock market clear.
There's never been a time in my life when I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I never felt that I knew it, and I've never felt that was important. I will say that in 10 or 20 or 30 years, I think stocks will be a lot higher than they are now. American business will do fine over time, and if you own a piece of it, and if you don't beat yourself, the only person that can cause you to get a bad result in stocks is yourself.
Susie Garib, senior special correspondent at Fortune and an NBR contributor, follows Mr. Buffett very closely, joins us now. His optimism, Susie, not only for the economy but for the stock market, is always very strong, unwavering, and yet today in light of really tepid growth. So how does he square the two?
He is truly a long-term investor, Tyler. I mean, as he said, whether it's 10 years or 20 years, and he advises investors not to think for this month or next month or this year and really think long-term. And, you know, it really bears it out. If you look over time and over long periods of history, these down markets that are so painful while we're going through them are just a blip in the scheme of things. So he says, basically, he's buy and hold.
I'll say this, any 85-year-old man who's a long-term investor is by definition an optimist. Right?
That's absolutely true. You know, Susie, IBM is one of his big holdings. The stock has not done well at all. And in the interview this morning on CNBC, he didn't give it one of his usual resounding endorsements. Take a listen.
A stock going down is a good thing unless the company itself is losing value. And sometimes that's the case and sometimes it isn't. I don't think it's the case with IBM, but I could be wrong.
So we'll turn to Susie. What do you think? What do you make of that?
It's more of what he didn't say. He didn't say anything about IBM's CEO, Ginni Rometty, who in the past, he has praised her profusely. So no mention of her or her strategy that she's been talking about. Nothing about IBM's market share or anything about its transformation into artificial intelligence. And I think that was very revealing that he said, I don't think we made a mistake buying IBM. He said, but I could be wrong. And if I am wrong, we'll accept it. And I thought, that's revealing.
It was rather a clipped way he finished that as we sit here and try and do a little criminology on him. One area that Mr. Buffett has come in for some criticism about is his relationship and his business dealings with a Brazilian business operator, private equity firm called 3G, a known and very aggressive cost cutter. Take us through that and what he said. That's right.
And you know, at the last annual meeting, Tyler, there were a lot of questions about 3G's tactics. Now, Buffett has been partners with them in a number of deals, most notably Kraft Heinz. But they share the same goals about making acquisitions. They want big companies for the long term, but their strategies are different. So 3G, like you said, they go in and they make drastic cuts and layoffs, and they put in new management. Buffett's style and Berkshire's style is buy a well-run company that has good management and then let them do it. But Buffett is in a tough situation. Berkshire is huge. They have billions of dollars of cash, and it's getting harder and harder to find well-run large companies that will significantly add to growth. So they've got to team up with someone else.
He also weighed in on Apple and that security versus privacy issue that is such front and center headline news. What do you think?
Yeah, he made the case that if we live in a dangerous world, worried about cyber threats or biological threats. And if you get credible information that there really is going to be a threat, and it is important to national security, you've got to cooperate. Now, he doesn't know Tim Cook. He admires him. But he said that if Apple really knew that there was a targeted threat and it was important to national security, this is where, what he says, security trumps privacy. But you can't always say that it's national security. National security has its limits.
Susie, thanks very much. Susie
Great being
Garrett,
with you.
Senior Special Correspondent with Fortune and an NPR contributor.
And another powerful letter to shareholders was issued this morning, this one from General Electric CEO Jeff Immelt. In it, he took on the government, political correctness, and activists. Mary Thompson has more on the surprising, blunt missive to shareholders.
Almost 16 years into his stint as CEO of General Electric, Jeff Immelt writing a no-holds-barred letter to shareholders.
I think the good guy backslapping is something that he's just tired of. That right now, I think if business has a voice, they should exercise that voice.
Following GE's most transformative year when it completed its biggest acquisition, started shrinking its once mighty finance arm, and tussled with Congress over the funding of the Import-Export Bank, Immelt saying the GE of the future won't be so friendly, noting the most important culture change ahead of us is to be completely intolerant of being nice for the sake of getting along. Immelt says the relationship with business and government is toxic and blames governments for hindering global growth, writing most government policy is anti-growth. In the U.S., we want exports, but seem to hate trade and exporters. Globally, governments love small business, but then regulate them to death. Strategist Greg Valliere saying in this case, Immelt's not alone.
What he said reflects the thinking of a lot of business people. They can get by, they can make profits, but to really grow, they need a friend in Washington, a friend among the politicians, rather than adversaries.
Immelt also taking on what he calls a culture of political correctness, which mires companies in processes that fail to produce good outcomes, writing it doesn't do any good to win awards for good governance if you're getting eaten alive by competitors. While Immelt says he welcomes the focus activist investors like Nelson Peltz bring to a firm, he says it's challenging for management to balance what activists want now and what activist regulation prevents the company from doing. Still, Yale's Jeffrey Sonnenfeld says it would be wrong to read the 19-page letter solely as a venting of Immelt's frustration. Sonnenfeld says it also reflects Immelt's pride in what GE has accomplished.
This is somebody who wants to really scream from the mountaintops, hey, we're getting there, we're doing this, we're getting it done.
Immelt's work far from being done. He's predicting GE will be a top 10 software firm by 2020 as it focuses on becoming a digital industrial powerhouse, one unafraid to say what's on its mind. For Nightly Business Report, I'm Mary Thompson in New York.
A federal judge in New York says Apple cannot be forced to give the FBI access to a locked iPhone in a Brooklyn drug trafficking case. The U.S. magistrate's decision could bolster Apple's case against a California judge's ruling that the company helped the government hack an iPhone used by one of the San Bernardino shooters who killed 14 people in December.
Stocks end the month of February on a bit of a down note despite gains in oil prices today. The declines accelerated into the close and are being attributed to late-day, end-of-month sell orders. Also, disappointing economic data and sharp losses in China's stock market didn't help. By the close, the Dow Jones Industrial Average fell 123 points to 16,516. NASDAQ was off by 32. The S&P 500 gave back 15, almost 16. For the month of February, the major averages were mostly flat, with the S&P and NASDAQ posting their first three-month losing streak since 2011. The industrials were up fractionally. Flat February is not necessarily, though, a bad omen for March. Deirdre Boza looks to the past to see what the future may hold.
Winter may not yet be over, but there are signs of spring in the air. And for the markets, there's indication that this year's earlier freeze may be thawing as well. After a terrible start to 2016, markets have managed to claw back losses from earlier in the month and end on a relatively flat note.
We do expect stocks to continue to appreciate between now and the end of the year. The difficulty in the short term is the unexpected, but the economic numbers are firming up pretty nicely. Employment has firmed and wages are now beginning to rise.
And if history is any guide, the comeback could continue. Over the last decade, March has been a good month to be long stocks. The S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite have all reliably moved higher in the month. But the real winner has been the small cap benchmark, the Russell 2000. It has traded positive in March every year but one since 2006 and far outperformed the broader markets. The results are even better when stocks finish February flat, as they did this year. In all four instances since 2002, all indexes have been positive the following March, and small caps have seen even bigger gains, returning nearly 4.5% on average. Some analysts are getting bullish on energy in March.
We like energy here. It's been beaten up for a long time, and the large integrated oil companies have begun to trade. They've disconnected from the price of oil. So ExxonMobil is up 5% year to date. We're moving that into one of our largest holdings and have just overweighted the energy sector.
History also suggests the sector could be due for a comeback. After flat Februaries, energy has been the best performing sector in March. But no such luck for two of the most beaten down sectors this year, technology and financials. Typically, they performed no better than a coin toss in March, trading negative about half the time. As always, past performance is no guarantee of future results, but for investors looking to shake off a cold winter, they may find some warmth in market returns next month. For Nightly Business Report, I'm Deirdre Boza in Vancouver, Canada.
Gold is shining. The metal had its best month in 4 years and is the top performing asset of 2016 so far. Today, prices extended their gains, settling above $1,200 an ounce. But why is this sector suddenly on such a hot streak after years of being so cold? Brian Sullivan has some answers from a big metals and mining conference in Hollywood, Florida.
2016 has largely been a disappointing year for most investors. Investors, that is, in nearly everything but gold and gold stocks. The yellow metal has been red hot. And here at the conference, the CEO of Newmont Mining told us why.
Fundamentals for the medium to long term are good for gold. When you look at both the supply and the demand side, on the supply side, people haven't been investing in new gold mines. You haven't had the investment in exploration. You expect new mine supply rather, to drop by about 17% over the next 5 years. Demand is still strong. Asia, still the major place where gold goes.
Like any commodity, supply-demand is a major part of the equation. But currencies have also played a role. And as central banks around the globe have acted, currency markets have started to move. As currencies move, nervous investors look to gold as a hedge. The CEO of the world's largest gold mining company, Barrick Gold, explained the relationship between currencies and the metal.
Positive. I mean, it's a store of wealth, reserve currency, so people are turn to gold in those uncertain times, and we're seeing that in the near term.
Ironically, though, it is the fall in price of another major commodity that has helped the gold mining companies: oil. Most of the mines operate in very remote locations. It's expensive to bring in all the fuel needed for the big mining vehicles. And as the price of oil has gone down, profitability has gone up. Newmont Mining CEO explained just how much.
For every $10 change in the price of oil, it's about $40 million to our free cash flow per year.
Of course, many people love gold simply because of jewelry. It has, after all, been a valuable asset for thousands of years. But if you are new to the gold game or thinking about becoming an investor in gold or gold stocks, know that it is more than just about beauty. You need to follow the currency markets and even the oil markets as well. For Nightly Business Report in Hollywood, Florida, I'm Brian Sullivan.
Still ahead, why there's heavy demand for dividend-paying stocks these days. Valeant Pharmaceuticals is under investigation by the SEC. The drug maker's disclosure today comes on top of an existing probe into a company Valeant bought last year called Salix. A company spokeswoman declined to comment on the content of the new inquiry. Meanwhile, the Valeant Pharmaceuticals chief executive is back in the corner office following a severe case of pneumonia. And Michael Pearson's first order of business on this day back was to withdraw the company's financial guidance and delay reporting fourth quarter earnings. The company says an updated outlook and its quarterly financial report will come sometime in the near term. Shares fell more than 18% on the news to $65.80.
It has now been 1 year since lumber liquidators began battling allegations about formaldehyde in its flooring, and the company said today that battle is not over. Despite the wider than expected quarterly loss, shares finished the session higher. Scott Cohn has more on the company's steep losses and why the company 1 year later is still doing damage control.
Lumber Liquidators has lost more than 3/4 of its market value since CBS's 60 Minutes alleged the company knowingly sold the tainted flooring from China. That's more than $1 billion in market cap. The company is not only losing value, it said today it's losing money. $56 million last year compared to a profit of $63 million the year before the controversy. Sales for the year plunged nearly 7%, including a nearly 14% drop in the fourth quarter. The company has replaced its CEO, hired a chief compliance officer, and eventually pulled the flooring in question from the market. So there was finally some hope that the worst would be over. Earlier this month, the Centers for Disease Control reported that the cancer risk from the flooring was minimal. But then, 3 days later, the agency said it had made a math error, and while the risk was still low, it was 3 times higher than previously thought. So now it's back to damage control, including this full-page newspaper ad saying Lumber Liquidators does not sell any of the products covered by the CDC's report, though not mentioning that the company did sell the products until last May. And here's CEO John Presley on a conference call with Wall Street analysts today.
The report did not speak to any products that Lumber Liquidators currently sells. And perhaps more importantly, the CDC has not recommended that customers replace this laminate flooring.
But those recommendations aren't final yet, and yet to weigh in, regulators here in California who've been investigating for more than a year. Today, Lumber Liquidators revealed it set aside another $1.5 million for potential fines, money it can't exactly afford. Scott Cohn, Nightly Business Report, San Francisco.
Carl Icahn makes a bid for Federal Mogul, and that is where we begin tonight's market focus. Icahn Enterprises, owned by the billionaire Carl Icahn, currently owns 82% of the auto parts maker and said it would like to buy the remaining shares. Federal Mogul said it will form a special committee of independent directors who will carefully review and evaluate the offer. The company also issued a better-than-expected earnings report for its latest quarter. Shares of Federal Mogul soared more than 45% to $7.26. Tribune Media topped analyst estimates on both its top and bottom lines in its latest quarter. However, despite that beat, the television station owner saw a nearly $400 million loss and said it will explore a possible sale or separation of select lines of business. Shares up 9% on that news to $35.90. NRG Energy said it will cut its annual dividend nearly 80%. The news comes after the company said it suffered a more than $6 billion loss in the fourth quarter. The company also reaffirmed plans to spin off its stake in its home, solar, and vehicle charging businesses. Shares fell almost 3% to $10.76. And Consol Energy saw its shares surge after the coal and natural gas producer said it would sell its Virginia coal mine and other assets to a private equity firm in a deal valued at $420 million. Consol said it will suspend its quarterly dividend once the deal takes effect. Shares up 10% to $8.63.
Taser, which makes law enforcement and military devices, issued better than expected earnings and revenue in its latest quarter. Results were driven in part by strong sales in the company's body camera equipment segment. Shares were up nearly 11% to $19.38. United Natural Foods saw its shares fall today after the company warned its revenue and profit targets will miss analysts' expectations. United Natural also said it would acquire a rival organic food distributor in a deal valued at roughly $217 million. Shares of United Natural Foods plunged 21% to $30.86. And Signet Jewelers and the parent company of Zales and Jared said same-store sales rose nearly 5% after a strong holiday shopping season, and that helped its preliminary profit top forecasts. The company also raised its quarterly dividend by 18% to 36 cents a share and said it had approved a $750 million share buyback program. Shares sparkled today, gaining more than 9% to $108.40.
Well, investors are turning to companies that pay hefty dividends and dumping shares of fast-growing industries such as technology. The S&P 500 High Yield Dividend Aristocrats Index, that's a name for you. It's made up of companies that have increased their dividends every year for at least 20 years. It's up this year compared with a decline in the broader S&P 500, as you see there. The trend was highlighted in a Wall Street Journal article today underscoring investor appetite for income. The reporter on that story is Greg Zuckerman, and he joins us now. Greg, always good to see you.
Great to be here.
Why this newfound religion of dividend-paying stocks? What's got investors' attention so suddenly?
Well, part of it is nervousness. So in a period when we're unsure about the economy, China, et cetera, and the stock market is so rocky, the solid dividends that some blue chips pay look much more attractive. They're also more attractive because we're less convinced that the Federal Reserve is going to be raising rates this year, and there won't be a series of rates. So if rates aren't rising, then these yields that the dividend stocks pay are much more attractive.
But Greg, are investors remiss if they don't really take a look at the stock itself and the dividend? I mean, a lot of people buy it thinking it's a bond equivalent, which it really is not.
It's interesting you say that. You do hear a lot of people who used to be sort of 60-40 saying they want to be more kind of 80-20, more equities than ever before. And as a substitute, they're buying these dividend stocks. And as you suggested, that's the danger. I mean, if you look at things like utilities, which are up this year, even everything else is down, they're up a good 6-7%. The PE ratio, the price earnings multiple, is pretty expensive relative to history. It's around 17 versus 15 is historically. So you're paying up to get this kind of safety. You have to remember that.
So yeah, and you look at some of these energy companies like NRG. We just talked about it. Consol suspending the dividend. Sometimes those dividends aren't as secure as we think they are. It occurs to me, Greg, that in part what is being reflected here is the idea that growth may not be there. And that you need to go with where you can get total return, and more of the total return may come from the dividend payout relatively than it has been historically coming from the growth side.
That's exactly right. So we talked about sort of the dangers of some of these stocks. The reason to buy them is, as you say, people don't spend enough time focusing on the total return. That includes the price, but also the dividends. And yeah, you want to buy some fast growers, tech companies and others when the economy is advancing. But when we're in a slow pace recovery, maybe we get 2-3% growth, 3% hopefully this year, then those that can give you a good 3-4% dividend return look much more valuable.
Greg, thank you so much. Appreciate the insights. Greg Zuckerman of the Wall Street Journal.
Coming up, leaping towards your financial goals, how you can use today, Leap Day, to jumpstart your financial planning.
All right, here's what to look at tomorrow. Automakers report their sales figures for February, historically the slowest month of the year for sales. And Super Tuesday, of course, the biggest day of the year for the 2016 primary season. And on Capitol Hill, Apple's legal chief and the director of the FBI are scheduled to testify on encryption and security. That will be very interesting, and it's what to watch Tuesday.
There are plenty of ways to mark leap year, but we've come up with one you might not have considered. Why not do a 4-year checkup of your money? From your retirement to your career, there's obviously plenty to think about, and see if you're on track for different milestones. Sharon Epperson joins us now with more. Good to see you as always, Sharon.
Good to be here.
So you should always, of course, be monitoring your career, but there are some kind of specific things to consider in this case, right?
Well, you're always keeping tabs on what your goals are, and here's a good time to check in and see if you're meeting the goals that you want. Have things changed over the last 4 years? Are you managing people? How are you competing against your peers? And how are you in terms of meeting those goals, whether it's trying to get a bonus or trying to manage other people? Think about your role as it is today and where you want it to be in 4 years as well.
I love any list where I only have to think about it once every 4 years. This is beautiful for me. Insurance, most especially something I would only like to think about every 4 years.
Whether it's your auto insurance, your home
what should I
insurance,
do
or
there?
life insurance. Well, auto insurance, if you're someone like me who keeps a car for a very long time, after a certain number of years, you don't need collision insurance. You don't need to think about all these different things that maybe you're paying for with auto insurance. So keep that in mind depending on how long you've had your car. When it comes to homeowners insurance, what things have you done differently in your home? Have you build a new bathroom? Have you upgraded certain things? Do you need to change your coverage in that regard? And in terms of life insurance, what things have changed in your lifestyle? Have you recently gotten married or divorced? Who's the beneficiary on your policy? Have you made the appropriate changes? And as your parents age, what do you know about what they have in terms of life insurance? And have you had that conversation? So those are things to check in with every 4 years.
And let's talk about retirement, the milestones to be examined. Obviously, it depends on your age. But
it depends on your age. One thing is if you have someone helping you with your finances, now's a good time to evaluate that financial advisor. You don't want to base it on 1 month's performance or maybe even 1 year, but 4 year, good time to check in and see how that's going for you. Look at your risk tolerance, how you're doing with that, and then see how much you're putting away for retirement. And here's something where leap year can really make a big difference. Just a little bit of an increase in what you're putting away can make a huge difference when you retire. Say you're 25 years old right now, and for the next 5 leap years, every 4 years, you increase your contributions to your 401k by 1%, you could have an extra $739 in retirement income when you retire at 67.
$739 a month?
A month.
That's a big difference. That's a meaningful difference.
But a lot of people say, wait a minute, I didn't start when I was 25. What if I'm 45 and I add another 1%? You can have, and do that over the next 4 leap years, you can have as much as $263 extra a month for retirement
income. And that's just 1%.
And that's just 1%, exactly. Of course, you should try to add more, but we're saying just small increments make a huge difference.
Sharon,
so get started now.
Always good advice.
Sharon,
thank you so much.
My pleasure.
Sharon Epperson.
See you in 4 years.
No, well before that. All right, that does it for us on Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Mathisen. Thanks for me as well. Have a great evening, and we'll see you back here tomorrow.
In March.